You're checking your portfolio again. That's the problem. Right now, while super microcomputer rockets up 15%, you're calculating what you missed. While Google drops 5%, you're wondering if you should have sold yesterday. Your thumb is hovering over the buy button on one and the sell button on the other, and neither decision has anything to do with value. How much has that cost you? Because here's what the Stoic philosophers understood that Wall Street doesn't want you to know. The fear of missing out isn't about missing opportunity. It's about being enslaved to comparison. And the market you're watching today, calm on the surface with a VIX at 17.48, hiding violent moves underneath. It's designed to exploit exactly that weakness. By the end of this, you'll know exactly why the investor who feels nothing during a 15% surge has already won, while the one celebrating is about to lose. Let me show you what I mean. The S&P 500 is down less than 0.5%. The Dow is actually positive by every measure of market stability. Today is calm. Boring, even. But you don't feel calm, do you? Because you're not watching the market. You're watching SMCI climb 15% in a single session, and somewhere in your mind, a voice is screaming that you're falling behind, that everyone else is getting rich while you stand still. That voice is expensive. It's the same voice that watches Netflix drop 5.5% and calls it opportunity. The same voice that sees Palantir down nearly 7% and wonders if the trend is broken. That voice doesn't analyze. It reacts. And every reaction costs you twice. Once in the bad trade you make, and once in the good trade you abandon. This is where most investing content tells you to control your emotions, to be disciplined, to stick to your plan. That's useless advice. You already know you should do that. What you don't know is why you can't. Seneca knew 2,000 years before circuit breakers and volatility indexes. He wrote this in his letters on ethics. No man is crushed by misfortune unless he has first been deceived by prosperity. Read that again. You are not hurt by what you miss. You are hurt by believing you are entitled to catch it. SMCI up 15% today. Did you own it yesterday? No? Then you didn't miss anything. You were never in that trade. But FOMO convinces you that every price movement in the universe is a referendum on your worth as an investor. Every stock that rises without you is proof you're losing. Every stock that falls after you buy is proof you're cursed. This is the deception Seneca warned about. The prosperity you see in others, the gains you witness from the outside, they create a phantom entitlement. You start to believe the market owes you those returns, that you deserve to catch every move. And when you don't experience it as neutrality. You experience it as loss. But you haven't lost anything. You simply didn't win something you were never owed. The Stoics had a phrase for this: preferred indifferent. Wealth is preferred, certainly. It's better to have it than not. But it's indifferent to your character, your judgment, your wisdom. The only thing you truly own is your response. And right now, your response is making you poor. Here's the proof. Spineco down 16% today. Where were you yesterday? If you owned it, are you selling now? If you didn't, are you buying? Most investors do neither. They freeze. Because FOMO works in both directions. Fear of missing the rebound. Fear of catching a falling knife. Fear of being wrong either way. So you do nothing, but it doesn't feel like patience. It feels like paralysis. This is what emotional investing costs you. Not just the bad trades. The mental bandwidth. The decision fatigue, the cortisol. You're spending capital you can't see on a scoreboard that doesn't exist. Let me take you inside a quiet office today. 47th floor, floor-to-ceiling windows overlooking a city that never stops moving. Marcus Sterling sits across from Alex Chen, and Alex's phone is face-up on the desk between them. Portfolio app open, red and green numbers flickering. Marcus doesn't look at it. Alex does. Every few seconds, eyes darting down, jaw tensing, back up. Finally, SMCI is up 15%. I had it on my watch list 3 weeks ago. Marcus waits. I should have bought it. Why? Because it's up 15%. That's not why you buy. That's when you regret. Silence. Alex looks back at the phone. Google's down 5%. Maybe that's the move. Is it cheaper than it was yesterday? The price is lower. That's not what I asked. More silence. You're not investing, Marcus says. You're comparing. Every stock that moves is a mirror, and you're asking it whether you're smart enough, fast enough, worthy enough. The market doesn't answer those questions. It just takes your money while you ask them. Alex puts the phone face down. Seneca watched fortunes rise and fall in the Roman Forum, the same way you watch them on that screen. He saw merchants chase every rumor, every whisper of profit from distant ports. And he wrote this: "It is not the man who has too little, but the man who craves more. That is poor." You think you're missing opportunity. You're actually drowning in it. Too many choices, too many comparisons, too much information about things you can never control. The VIX sits at 17.48. Calm by historical standards. But Alex doesn't feel calm. Because Alex isn't trading the market. Alex is trading against everyone else in it. This is the framework. The Stoic investor doesn't ignore opportunity. He defines it strictly before the market opens, before the price moves, before emotion has anything to say about it. He writes down exactly what constitutes a buy, exactly what constitutes a sell, valuation metrics, risk parameters, time horizon, position size, all of it predetermined. Then the market does what it does. SMCI up 15%? Check the framework. Does it meet your buying criteria? No? Then it's not an opportunity. It's noise. Google down 5%? Check the framework. Does it trigger a buy signal based on rules you set when you were calm? No. Then you don't buy. This isn't discipline. Discipline is forcing yourself not to do what you want to do. This is clarity. You're not fighting temptation. You're categorizing information. This price movement is either relevant to your predefined strategy or it isn't. There's no emotional content to analyze. Most investors invert this. They feel first, then try to rationalize. They see SMCI rocket and feel urgency, then reverse engineer reasons why it's a good buy. They see their framework say no and think the framework must be wrong because the feeling is so strong. The Stoic investor trusts the framework more than the feeling because the framework was built by his best self. The feeling is generated by his most primitive self, and the primitive self is batting about 2% against market volatility. Seneca again. The wise man looks to the purpose of all actions, not their consequences. You cannot control whether SMCI goes up 15%. You cannot control whether you happen to be holding it when it does. You can only control whether your process is sound, whether your analysis is thorough, whether you're buying value or buying envy. Everything else is just scorekeeping in a game you'll never win, because there will always be a stock that moved more. Always be someone who bought earlier, sold higher, timed it better. If your peace depends on beating them, you will never have peace. And an investor without peace makes expensive mistakes. So here's what changes today. You stop asking what the market did. You start asking what your framework says. You stop comparing your returns to the ticker symbols trending on social media. You start comparing your decisions to the criteria you set in advance. When SMCI jumps 15% and you don't own it, your only question is, did I violate my process by not owning it? If the answer is no, there's nothing to feel. You executed correctly. The outcome is irrelevant. When SpineCo drops 16%, same question. Did my framework anticipate this risk? Did I size the position accordingly? Did I follow my rules? If yes, then even a loss is a win. You proved you can stick to your strategy under pressure. This is how Stoic investors sleep while the market churns. Not because they don't care about money. Because they've transferred their identity from outcomes they can't control to processes they can. You are not your portfolio balance. You are the quality of your decisions. And the quality of your decisions has nothing to do with whether SMCI goes up today. The VIX is calm. Your mind should be too. Your emotions are costing you more than any market crash ever will. Next video proves it.